and welcome to Moneycontrol. Well, it seems to be a very happy morning. The markets are well past the 19,000 mark, up about 100 points today, and the momentum continues to be very strong. And I have with me Vikas Khemani from Carnelian Capital to take the conversation ahead on what to look for in markets like this. Thank you, Vikas, for joining me here today.
Pleasure.
What's your sense? How long is this bull run really going to continue? What's the next stop?
I think it's a long journey. What we have seen is just the start of a very long wealth creation cycle for Indian economy. And, I don't know about the short-term market can be volatile, corrections can always happen, but I see we are in a very, very long journey, and over the next 5 to 10 years, we will continue to see markets doing very well. And every time, market hits new high, we get excited, but it has to keep hitting new high, especially for an economy like India, which is growing so well, and there is no other economic, economy in the world which is so well placed as India is today. So it will attract global attention. It will attract global flows. Domestically, India has a lot of money. So I think we are in a very, very structured bull market. In that, there will be intermittent corrections, but if I take 5 years view, I think we are in a very sorted situation.
But especially when you are at the all-time high, what is your approach this time around? Is it more of caution because we are at an all-time high, or is it giving you that extra confidence that, well, we are now getting into uncharted territory and maybe better things will come more quickly than we anticipated?
So I think I always would say that index is just a number. It is not uncharted territory. We have seen this journey many times over, and every time I think there's a new high. Let me give you a perspective. I remember distinctly in 2003, because that is the time when I had joined Edelweiss, market was 800 points.
Yeah.
Today it is 19,000. In 20 years, it's almost 22, 23 times. Right. In this period, we have had UPA1, UPA2, global financial crisis, 3G scam, coal scam, Brexit, demonetization, Fissile 5, pandemic, ILFS crisis.
Yeah.
You can name the situation that has happened. But in this journey, only market has kept on hitting new highs. So it is the sheer power of the Indian economy, the demographic profile, which we very often underestimate in day-to-day movement of the price. And if you believe, and by the way, 22, 23 times over 20 years is like almost 17-18% CAGR at a market level. And if you are a smart investor, you can do much better on that, right? So I think that's a great journey. So same thing, I feel that the way I see is a continuation of the same journey, even with more conviction and power. Because today in India, historically we had manufacturing not doing well. Historically we were largely services economy. A lot of other sectors were not participating. Today, we have a fairly well balanced economy, which is focusing on domestic consumption, exports, investments, and our financials are very well. I think we are one of the best fiscally prudent country.
Right.
So our current account deficit is all right. Our fiscal deficit is all right. So you look at any point, we are in one of the best situation, macro, micro, corporate profits, everything. So I see no reason why it can't do better than what we have done in the last 20 years.
Correct. No, I agree with you, because if you look at a 20 years cycle, of course, we've done exceptionally well. The compounding has been very good. But as you know, markets tend to be lumpy, right? If you looked at 2008, 10 to 2019, right? From 2019 to now, we've seen about 70-80% gain. Just from, let's say, pre-COVID, January 2020, you were probably still at 11,000. Now we are at 19,000. So a lot of this gain has got bunched up in the last 2-3 years. Of course, there is no denial that last 1 year we've really not done anything. In the context of this lumpiness, when we look at the next 2-3 years, would you see there should be more moderate gains, or we can surpass what we have seen over the last 3 years?
I think we will. I don't know whether it will surpass as a percentage return, but I think next 3 to 4 years or 5 years, I think index can still give, anywhere between 16 to 20% kind of return. For the simple reason I mentioned that our micros are very well placed, macros are very well placed. We don't have any excesses in anything. Look at that. Our banking sector is one of the best shape ever. Balance sheets are capitalized, ready to grow.
Yeah.
Our services sector is very well placed. our manufacturing sector, which is additional round of kicker, is doing well. Real estate sector, which was in doldrums, is doing well. Infrastructure, we have been spending a lot of money across the board building up. So if you see, there's so many drivers of the growth, right, which did not exist in this size and proportion before. So they are only going to contribute more. We are in the middle of the corporate profit cycle. Typically, corporate profit peaks out at 7-8% of the GDP and bottoms at 2% of GDP. We are somewhere around 4-4.5%.
Right.
So this probably can go towards 7-8% before it, in my opinion, peaks out. And the comfort which I derive, that there are no excesses, so there's no bubble situation anywhere right now. Of course, pockets of bubbles will always be there in micro segment, micro markets, micro sectors. That I'm not talking about. At a market level, I don't see a bubble kind of situation anywhere, and maybe we'll get there because market always oscillates between euphoria and fear.
Yes.
And we are somewhere probably mid of the cycle, and I see next 3 to 5 years continues to remain very robust. So I would not be overly cautious just because it is hitting 19,000.
Sure. And when you talk about this earnings growth, moving from 4% of GDP to 8-9% of GDP, what do you think will be the underlying driving force? I mean, where do you see that earnings pool really aggregating from?
So again, the beauty, like I was saying, the beauty of this time around is that we have a very well diversified earning pool. Banking is doing very well, contributing to the growth. Services continues to remain robust. Manufacturing, there's an additional kicker which has come there. You might see a bit of accelerated because we have low base. Right. So I think this time around, I think we will be very balanced growth across the board. Typically, when you are, let's say, in other emerging markets where these are primarily export-driven economies or commodity-driven economies, they tend to get shaken up when the commodity prices go down.
Right.
In case of India, we are balance of domestic consumption, exports, and investment.
Right.
We are balance of services, manufacturing, and so what I'm saying is, like in China, it is hugely export dependent.
Right.
So as exports go down, their economy gets weaker. Right. But India is still reasonably balanced market. So I think we will see a very widespread earning growth across various sectors. Of course, there will be some sectors that will be accelerated and doing accelerating growth. That, of course, our job is to identify some of them. But I think corporate level, I would be surprised if India does not grow earnings between 16 to 18% over a 5-year period.
So this itself, you think, will be more domestic demand driven, or how do you see that earnings growth really? Where do you see that emerging from? Or is there scope for a lot of operating leverage to kick in, which will sort of catapult earnings? Where does it really come from?
I think operating leverage part is over, according to me, over last 2.5 years, because we had huge underutilized capacity, demands came out. So operating leverage part by and large is over. Now it will come from the new capacity creations and all those things in case of manufacturing. But demand is very robust in India. We have a very good, so we are an economy of demand, domestic consumption, and are also exports are doing well now. And the new vectors of exports are opening up because of China Plus One and this and that. And also we are substituting imports. So if you are substituting imports, that manufacturing also has to happen here. So I think from a profit pool perspective, if I were to talk the largest from a quantum of the profit pool, on absolute basis, the growth will be highest in the banking, because that's a large
part of the index also.
Large part of the index and large profit pool also.
Right.
But if I were to say speed of the growth or percentage growth, on an accelerated basis, because the base is lower, it will be manufacturing. So, and there will be other consumption will contribute. All other sectors will contribute, I think, but these two will probably stand out.
Sure. So if you're saying it's in manufacturing, I mean, private capex really has not picked up the way we thought it would pick up in the last 18 months, right? When do you see this happening or accelerating from? It's not that it's not happened, but the pace at which you would have liked to happen, perhaps it's not happened. When do you see that happening?
I don't think that's correct statement. Private capex has picked up in a very meaningful manner. How does private capex get reflected? It first gets reflected into your order book of all the capital goods companies. Right? Go and check every capital goods company's order book has been growing significantly. Right?
Isn't that more driven by government expenditure? I mean, essentially a lot of investments and infrastructure.
No, it's all. I mean, let's say any capital goods company you take, right? The order book cycle is, now it's gone up. If earlier it was 3 months, 6 months, 9 months. There are a lot of, see, what is different this time around. Historically, when we talked about capex cycle, let's go back to 2005 to 7 or 8 kind of capex cycle. Lot of mega projects like 5,000 crore, 10,000 crore, 20,000 crore, largely led by power sector came about. We all know what is the situation now. Why those projects came about, first of all, because it was driven by irrational lending, by promoters which were not capable, or basically their motivations were very different. Right? They were creating assets using public money for private, and we saw what all has happened.
How it ended, yeah.
So the reason why that kind of capex came about was not rational. But this time around, we are not seeing that kind of massive capex except by few houses like Birla, JSW, Reliance, who have a solid balance sheet.
Right.
Last time, difference of capex was that anybody could do, capex likes of groups like Glanco, and many of them came up overnight.
Right.
Without having any balance sheet, and they said we could do anything kind of thing.
Right.
Today, the capex is led by people who are solid balance sheet, solid financial, rational people, right? Based by the merits of the projects. There are lots of another difference this time around is that there are a lot of SME and MSME capex is coming about, 50 to 500 crore kind of capex. So let's say if I'm a chemical company, I am doing 200 crore capex, but 200 crore capex in chemical is a very big deal. A 500 crore capex in a chemical is a very big deal. Now, if I compare that 500 crore with the power project 5,000 crore, it doesn't look very big.
Right.
But the fact is that this capex is must across various to substitute our import, right? And the power capex, is getting substituted by the solar. Right. If you don't feel, but that's like massive amount of investment is gone. Same thing is happening in hydrogen. You must be reading it.
Yes.
So there are a lot of the data center, by the way, is a massive capex which is going around. Check that. So data center is actually a new factory, effectively, right? So there's a massive capacity which is getting built by domestics, captives, and many people, right? Now that's a capex. ABB has said that this time around, a change of strategy has happened where earlier they focused only on mega project. This time around they have a MSME focused. When ABB changes the strategy to focus on MSME, it tells you something.
Right.
So capex is picking. In fact, I am not happy. I'm happy that it is picking up in a calibrated manner, so that it does not generate problems of
over enthusiasm
and fuel doesn't get built, and demand doesn't grow like 5x in a year. It grows slowly, and because manufacturing is a very different animal. So I think when we talk to companies, capex is picking. And I make this statement very carefully, and I'm saying this with a lot of. I don't know any company which is not growing and not preparing for growth in their own capacity. If I'm a small, I'm putting my 10 crore capex. If I'm large, I'm putting my 1,000 crore capex. In their own capacity, every single company is preparing for growth. If they don't want to grow, that's a very different matter. But generally speaking, I have not come across a single company which is saying I'm not preparing for growth. That tells you the mindset of the entrepreneurs and companies.
Sure. And if you look at, again, you talked about exports, right? Now, if we were to see a slowdown in the Western markets, do you think that is going to impact our exports in a meaningful way? Should we be worried about that part at all, or we have overcome that stage?
Yes and no. See, whenever there is a demand slowdown in an end market, there could be potentially some impact. But the beauty here this time around, is because of China plus one, a lot of market share shift is happening. So let's say, just to explain with numbers, let's say total market pie is 100. And, if let's say India's market share was 2, and hypothetically China's market share was, let's say, 40. Now, if this 100, even if it does not grow or it degrows, even if my market share going from 2 to 3 is good enough for me to give growth.
Sure.
Which that can come from China, that can come from anywhere. So India is right now witnessing growth of shift of market share.
Sure.
Then really the overall growth market share.
Sure.
Of course, when markets start growing, India will also participate in that.
You'll have a double kicker.
Correct. But right now we are witnessing growth in export from the shift of market share.
Fair enough. And the other thing that is also different from this time is the fact that you're also getting a lot of flows, which is, allocation moving away from China into India. How sustainable do you think is that trend?
So again, there are two things. One is overall emerging market allocation. Secondly, India's share going up.
Right.
So both have a very different right now driver. First of all, I think there's a very big historical 40-50 year trend. Whenever Fed raises interest rates, they pull out money from emerging market because emerging market economy weakens, and then so they preempt and pull out money from emerging markets. And the moment that interest rate peaks out and starts coming down, the same money comes back towards emerging market. So we have seen massive amount of outflow over last 2 years. Once Fed started talking about raising of interest rates, that has happened. My view is that once, and we think the interest rates are peaked out, and they will start coming down in the next 6 to 12 months time. You will see massive flow coming towards emerging market in general. Secondly, this time around, like there is no other market which offers India's profile in terms of growth, sustainability, diversity, and reliability. We will see disproportionately large share from that basket towards India.
Sure.
So whatever $40 billion we lost, in my opinion, that much and more would come back to India over next few years, and that's the reason I say that your earning kicker. I mean, markets are driven by only two things: earnings and liquidity. So you have right now both working for it, and this I've been saying for now almost 6-7 months that when even markets were down, because they don't change. Markets can be down for an event for a few weeks, but structurally these can't change. They are not changing. So I think both earnings and liquidity both will remain very, very sort of solid, and markets will do very well in short term, medium term, long term.
Sure. So no, my question was really about China, because around January there was a lot of optimism about their reopening, and people were saying that money will flow back into China when there is growth out there. But after that, of course, February, March onwards, that story sort of got nearly killed because it didn't go the way it was anticipated to go. Now, if there is a resurgence out there, if there is economic rebound in China, do you think some part of it could be taken away once again?
I don't think that see, first of all, it's not that China is doing some, right now. China is sleeping and they are not doing. It's there are two things. One is that, or to understand this, there are few things we have to understand. First of all, China's cost structure itself is changing.
Yeah.
China has become expensive on many counts. China's labor cost is $800. Our labor cost is $200. Our power cost is cheaper than China right now. Our logistics costs are expensive than China, but that is getting fixed. So first of all, on a lot of segments, India is cheaper than China, number one. Secondly, China is trying to reduce their dependence on their commitment. Because of their commitment to carbon emission, they are letting go of some of the polluting industry.
Correct.
Right? Thirdly, there's a very big China plus anti-China sentiment across the globe, because we saw what vulnerabilities were there in the middle of COVID. So globally, every company is having a strategy of supply chain diversification. It is not about only cost, it is about resilience. So even if India, first of all, India is kind of more or less at par on the cost, but even if it's not a par of the cost, India will still get some money, business from global corporations. So all these factors, are not short term in nature. They are more multi-year, decadal in nature.
Right.
And even if China bounces, and it's not that China is not right now shut and they're not doing anything. China is doing well in their own right. Of course, they have their own political and all those issues, which most of us, at least I am not privy to what is happening there. But one thing is clear, that every global corporate will look India very differently, is looking at India very differently, both from outsourcing perspective and market perspective. Today, Tesla one point in time did not come to India. Today they are looking to come to India. Every global corporation is looking to come and set up, whether it is Apple, Samsung, we hear every day some news, right, coming through and setting up. Why are they doing it here? So it is, I know a company which is, they're in Pune hiring 1,500 people, R&D center, they're shifting from China to Pune. Now when 1,500, white collar jobs gets created, you can imagine what happens to that. And this is only one company, micro market, because and they are setting, they will be like scientists, so well paid engineers and scientists, and so they are well paid jobs. So, and this is just one.
Yeah.
My anecdote, but there are many such anecdotes. Correct. So I think this is a trend.
No, the fundamental shift is for sure very clear, and it has been playing out also in the real economy, in the stock markets over the last 4-5 years. I'm just saying that the fund flow story is that also changing decisively.
It is changed already. So if you see in last 6 months also, India has got disproportionately large share within whatever flows that we have come. Right? And I always tell people that look at what $40 billion went away. Indian market absorbed the entire sell flow because of thanks to domestic liquidity, which is not going anywhere. What will happen when that $40 billion and more comes back? What will happen to markets? That one has to kind of keep in mind from a
So
liquidity
what
point of view.
happens? Valuations go through the
Go through
roof?
the roof, yeah. So people, this is what I tell people, that people who are complaining about Indian markets are expensive. I would say they will become even more expensive.
Right.
Now we can keep looking at that, they are expensive, your choice. I mean, I'm nobody to please, but I'm saying if this hypothesis turns out to be true, Indian markets will become even more expensive. Because ultimately, liquidity drives the valuations.
Correct. So how do you approach stocks then? I mean, if you think the game is all about, becoming more expensive, how do you fundamentally, is there a, would you realign your thinking in terms of the kind of inflows would have on valuations? Would you evaluate those stories a little differently from what you would?
No, I think from as far as we are concerned, our investing style is very simple. We believe in buying quality company at a reasonable price. We do not believe in buying at any price. Okay, so very simple. Wherever we find sustenance of growth based on our research framework, and it doesn't have to be very cheap. It doesn't have to be very expensive. As long as it is a fair value zone, we are happy to capture the earnings growth. Of course, we have a very big focus on identifying companies where there can be re-rating also. That's where our own proprietary framework is there, where what we call magic basket,
Yeah.
where we identify companies where we can get both earnings growth and valuation re-rating. So that we continue to do. So that is supposed to get, companies which can get re-rated. Other than that, also there are companies which will compound for long at 15 to 18%, and one should remain invested. So quality of management, quality of the business is very very essential to us. And we will not buy at any price. We are happy to buy at a fair price or at a cheaper price. So anything between reasonable price to a fair price, we are happy to buy. We stay away typically from any, and I encourage everybody to stay away from fads. In every market, there are fads. We saw some time ago fads in called new tech, right? And we saw what has happened, right? I think some bit of a fad is there in many defense stocks, right? We saw fad in chemical stocks in 22,
Yeah.
and we saw what happened in 22 and 23, right? So whenever you lose your sanity and you be part of the fads, uh, nothing remains permanent forever. So if you think some euphoria is getting built, stay away. FOMO is a very hard thing to manage.
Right.
So I think it's again fad. FOMO is continuous
So,
journey.
so, two questions. One is, how do you, get away from FOMO? And second thing is, where do you see fad building up right now?
So like I said, that I think I see some pockets of defense stories where there are fads getting built. Today when you say defense name, like I remember meeting a company with 150 crore turnover in recently somewhere, and the entrepreneur said, I will go public soon, and my market cap would be 3,000 crores. Now when entrepreneurs start thinking that way, that tells you that euphoria is there. Be cautious, be nimble, and stay away from that. Or even if you're doing, you have
So
to
you're
be very
saying
careful.
defense.
So
Defense is one
yeah,
space.
and again, I'm not saying defense is not a good opportunity. I'm not making that point. I'm saying there are fads, and you got to be part of it. Because every defense company will not make money today. A lot of people start representing normal work as a defense play. It's like I remember in 21, because specialty chemical was doing well, even commodity chemical companies started calling themselves specialty chemical. So these are the potential. I mean, always we see this kind of behaviors
Exuberance,
on
yeah.
part of exuberance, behaviors on part of management as well as investors.
Right.
So you have to be sort of very careful about not being that. And to avoid FOMO, first of all, you have to have conviction, courage of conviction. You have to have conviction in your own thought process. You have to believe what you believe in, right? And that does not mean that you are not close to your listening what's happening in the markets. It's a very thin line of difference between what to take and what not to take. So some things you have to be very strong and no change in that, and some things you have to keep looking at data points. So we believe that we have a very robust framework of evaluating ideas, and sometimes if we don't understand, we stay away. That's fine.
So, because you made this point about buying good quality businesses at reasonable valuations, but whenever you look at all these stories, whether it's Dixon or Keynes or many of these Amber or many of these established enterprises which have a good execution track record, that the management is good, capable of capturing this growth. It's already in the price, and you always you wish that they were cheaper, but they don't get cheaper. um, and you probably have to constantly look for the next ones in those space. How do you approach, and how do you build that into your valuation?
So
Because you have to, right now, if you see in the markets, this participation is very broad based. Lots of small companies, mid caps, small caps have participated, probably done better than large caps. And people say, okay, it's a smaller company, gets a better multiple than even larger companies, because the expectation is that, or the assumption is that their growth rates will be stronger and therefore they can be valued. But then we also have to recognize that there is fragility in smaller enterprises, and there are risks associated with that. So how do you look at it, and some pointers for the viewers on how do you evaluate all of this?
it's a good question. And again, since you mentioned, let me again tell you, there is a bit of a fad also going on in right now in smaller mid caps. Every single day we see companies which are not worthy. They get traded where they get traded. So idea is to kind of avoid some of those names. So you have to be very thorough in your research in something like this. Coming to your question on what is factored in, what is not, right? That's where I think a lot of art and science lies, right? If you think that it's fully priced, given let's say next 2-3 years profit, I think you could with reasonable, you can make out what kind of max growth this company can do, right? If a company can max do 15-20% growth, and if it's trading at 60-70 p, I think you got to be careful, right? Because no manufacturing business goes one way. There's always a cycle, and disappointment happens in 1 or 2 quarters. You will get your own time. I have seen many companies I have tracked for many years. I have felt missed out, and then suddenly you get some news and that company is available at your price, and that time you get in. So you got to be patient, and sometimes if you miss your liked company, that's fine. Market will not give you all the time opportunity. It's fine. So then, how to avoid FOMO? Many times it has happened to me. A company I love, but I was not able to buy. Uh, because ultimately, fundamental rule of investing is that risk reward has to be in your favor. You are taking risk. Even in a best quality company, you can call it whether TCS, Infosys, ICICI Bank, or best managed company also, you run risk. Because risk comes from environment, risk comes from unanticipated factors. So risk reward has to be in your favor when you invest. So and I'm not saying any of the names you mentioned, or I think there are many names which are trading expensive. You stayed away from them. I mean, how do you value a 4% margin company at 100 p, even if it goes at 20%, 30%? But a lot of market investors were there, and we saw how companies corrected 50-60% from their peak, and still I find them expensive, right? So we stayed away. We stayed away, and sometimes money in the bank is more valuable than in equity, and staying. You will get markets give ample opportunities.
Sure.
Recently, SVB crisis happened. I think market gave good opportunity. How many people had conviction to buy that time? If your fundamental belief in India story is there, you will go deploy your money. But if you are shaken on the fundamental story of the market, you will not put them. So it all boils down to your conviction, your depth of knowledge, your research, whether at a country level or company level, in the middle of the adversity.
Sure. So, in small cap, mid caps, do you think we are in a bubble territory right now, or you would not?
No, there are pockets. There are pockets right now, where we think that small cap and mid cap, there is a bit of a stretch which has happened. And like point you rightly mentioned, that whether we like it or not, small company has its own, business model facility issue. Smaller companies, and the other funny part is that these days we have this SME IPOs happening, right?
Yeah.
And in SME, companies will come and compare themselves, which are like raising 10, 20, 30 crores, and benchmark the valuation of the listed company, which is bizarre thing to do, right?
Correct.
But those are the excesses of the bull market, and only thing by being, careful and avoiding FOMO, it might happen that you missed a company and that double down listing. It will happen. It has happened in the past. It will happen.
Correct.
Zomato listed, Paytm listed, whatever. I'm saying all companies which listed very well on listing, and if you did not get, you will feel missed out. But fact is that today you have not been able to retain money. So idea is there are pockets of overvaluations in sectors and small caps also, especially. and one has to be very
Can you
careful.
pick a few zones of overvaluation? Where do you see that
Like I said,
specifically?
defense is one, uh, contract manufacturing, China plus one is again, situation. The funnily right now, I'll tell you, that is the risk part, but I'll tell you the opportunity part. And this is what the beauty of market is. 2021, everybody as an uncle wanted to buy chemicals. Today, nobody wants to touch chemicals. But the fact is that the 10-year trend of chemical has not changed. It is still there.
Correct.
So if you are a sane investor, if you have conviction that this chemical is 10-year story, you would rather buy chemical than buying a defense stock or a company making 4% margin on a PC board, because you will buy that, right? Because chemical companies are here to stay. They will grow. They will go 10x from here. But then you have to have that. So we try to at least stay away from this set and focus wherever market is not focusing, and that's where our magic stories
So
come from.
where is that pocket? Where you see maximum in this market, you see maximum pessimism in your mind.
Chemicals is what I'm saying. Today, nobody wants to. Go and check the percentage of ownership in chemicals in 21 and today.
Has gone down, sir.
To the extent, I mean, we look at very interesting. Recently, our guys were at a conference. A very large API company was presenting there, and then there was another. I won't name the China plus one kind of manufacturing play was there. The same company came to conference 2 years. There were 100 investors in to meet them. This time around, there were not even 10 investors to meet. This indicator tells you that the level of interest in that company. But that company is solid. It is, our conviction is going to come through. So you look at a lot of indicators that where the crowd is moving. Now, when the crowd is moving, you stay away from those crowds, because ultimately we have seen time and again that crowd is there where FOMO is, and most people can't control that temperament. So you have to be, have conviction. You have to sometimes temperament to go wrong.
Sure. And so is China plus one your large, the space that you really like?
Yeah, we have in fact, we launched a fund capturing China plus
the
today. Shift strategy.
Yes.
Today, everybody's talking. A lot of people are talking about China plus one. We launched this fund in September 2020, which is 6 months after the pandemic. So, and our story hasn't changed, and that fund has delivered like some 40% plus CAGR versus benchmark of 20%. So, so we've been delivering this thing, and we are not saying this it's a decadal thing. So where we are in China, we are in manufacturing where China was in 2005. We are in manufacturing where IT was in mid-90s. So you can imagine what kind of conviction we have, what kind of faith we have in terms of playing this out. Now, of course, manufacturing is a very wide sector. You can't, within manufacturing also you got to find sub-segment which will benefit. Then you have to find companies which will benefit. So it's not, so simple that, because manufacturing, you can take steel also, and you can take footwear also, you can take chemicals also, you can take automobiles. So it's a very wide sector, but you got to identify what we play. What we are rather playing more is anything which sits between import substitution and export oriented, or combination of both.
Sure.
Where we think the real opportunity lies over next 5-10 years.
Sure. Two questions before I wrap up. One is on real estate. You've seen a lot of surge in demand over the last quarter or so. Do you think we are, and last 10 years really nothing happened, prices have not really moved up significantly. Of course, in pockets, last 1 year also real estate prices have moved up. Do you think we are at the foothills of bull market in real estate? Can that play out at all, or is this like a false start? And second is, of course, this new tech space. How do you look at it? Because of late, a lot of buying interest has come into some of these stocks. But is this a zone that we should start looking at it, or this anchoring bias of benchmarking against the issue price and saying that it's down 20%, it's time to buy? Is that, how do you look at that whole situation?
Sure. I think both good questions. Real estate, again, if you see, very interesting change happened post RERA development. I think RERA was, in my opinion, a watershed moment in the life of real estate sector.
Correct.
Just like, I always give this example, just like what happened to capital markets post formation of SEBI. If you see, before SEBI, it was all unorganized, unclear, right? And we might have different complaints with SEBI on a lot of things they do. But fact is that if I look at a 25-year picture,
yeah,
Today, capital markets are what they are because of SEBI, because rules of law is there. You can do what. So today, market has grown because of a lot of things which were being done to build infrastructure. Same thing, real estate is going. First 4 5 years passed after era was initial teething years. SEBI got formed in '92. Market really started picking up '96, '97. So 4 5 years were painful period. A lot of unorganized players went out. Good players are coming in. Now there's a rule of law. And some regulation there. Customers are protected. So I think, and still real estate is very underrepresented in overall market cap of the country.
Yes.
So you will see, and there are two different things. Real estate as an asset class and real estate stocks, both are two different things. But if India grows, which I feel will strongly grow, real estate is bound to do well. There's no question in my mind, because ultimately more factories are coming, more buildings are getting built, more infrastructure getting built. The piece of land remains, limited, right? So you are basically creating more and more demand for real estate. More jobs are getting created. Today, whatever jobs have got created in IT sector has created huge demand in Bangalore, Hyderabad, Pune, or everywhere else. Manufacturing is creating massive job, by the way.
Correct.
And that sector is also going to create job creation, infrastructure development, and formation of RERA. All are pointing towards in a very structural way that real estate sector is set for a transforming journey over next 10, 15, 20 years. Of course, it's not going one way; it will take time, but it's a great. And real estate is, I personally believe, the only two asset class which really meaningfully protect value of money or beat inflation, which is real estate and equities. So I think real estate will, if not beat, at least meet inflation. I think it will beat also, probably, given what other trajectories are there.
So you would make a case for real estate stocks?
So again, that's how I was saying. Real estate asset class and stocks are different.
Yes.
Now, of course, that also will change all these things, because now real estate developers also will change themselves, because historically more inefficient player did well, because more you delayed the project, land prices went up and they made more profits.
Right.
Now, because of RERA and a lot of other things, your game has changed from buying land, converting and delivering, just like any other manufacturing player or any other. You're manufacturing houses.
Right.
So your efficiency will determine your profitability, not
Sure.
that how long you're holding in.
Sure.
So the game is changing. So we like developers who understand this game well, who have brands, who can, and again at a reasonable value, because there are a lot of, again, faulty thing happening there. Because what is happening is because, so like me, a lot of people have view on real estate. But funny part is that there are only few good players. So most people, especially FIs, go and buy those names.
Yeah.
As a result of that, they become very expensive.
Correct.
So you got to be very careful in that.
So you prefer the P&L sort of place as opposed to the asset
Absolutely.
monetization kind of
Absolutely.
place?
Yes.
Sure. Okay. And new tech.
On the new tech, again, we study. It's not that we don't study. We study every business model. We're trying. We have seen that some people have bought off late and all. Our view still is that, let's take a company like Zomato, right? We don't understand this, and I'm not saying people are buying are stupid or we don't understand. We are a two-player market. You have 60-70,000 crore industry from a top-line perspective, right? Two-player market, 60-70,000 crore industry, and still you are not making money. How, when I will make money, when I will get to ROE, when I will value the company, right? So it is beyond our understanding. We don't understand, hence we stay away. Then you have disruption risks like ONDC, which is coming through.
Yeah.
Now, how do you play that out? I don't know. I mean, maybe they will, maybe they know, but I know that there's potential risk there, right? So technology-led business model will evolve, no doubt on that. They will morph, they will, and out of some companies will survive and grow, but we still don't understand from a risk reward point of view, why should you invest? Yes, they have corrected 60%, 70%.
Yes.
It's like Nika. At even current market price, it probably is expensive, because still, it's a good company, no doubt about it.
Correct.
They have done a great job, and it's a good segment. But how it is different than, why it is new tech? How it is different than any consumer company? They are in fact opening the stores physically. Right?
Correct.
And it's a phenomenal company. I'm not making that point that it's not, but I think it's still outside our comfort zone.
Sure. I guess that's all we have for today. Thank you so much, Vikas, for joining today.
Thank you, Mahalakshmi, for having me.
Sure.